Alright guys, again, good afternoon. Welcome to attend my Introduction to Managerial Accounting online class. Well, in the last class, I basically introduced how to allocate the overhead. As I said again and again, there are three major parts for manufacturing companies. As the product cost, they are first, direct material. Second, direct labors. Third, which is the difficult part to allocate, is overhead allocation. Well, in addition to the traditional overhead allocation methods based on activity-based management, I introduced how to use activity-based costing to allocate the overhead in the manufacturing department. Well, today we will start the class by introducing the activity-based management used in service company. Activity-based management is not just for manufacturing companies. Many service companies also use ABM, which is activity-based management, ABM. For example, a hospital may use activity-based costing to determine the cost of treating each patient. Activities could include admitting the patient, conducting procedures such as X-rays or MRIs, and providing care for patients in their hospital rooms. The hospital would follow the same 4-step as how it is used in the manufacturing company. Same 4 steps. Again, let's have a quick review. First, to identify the activities and estimate their cost of the indirect cost. Second, to identify allocation base for each activity and estimate the total quantity of each allocation base. Third, to compute the predetermined overhead allocation rate for each activity. And lastly, we should allocate the indirect cost based on the predetermined allocation cost and the quantity of activities that incurred on each specific step. So here, let's see an example in a hospital, the Gatewell Hospital. Let's assume that this hospital wishes to allocate overhead costs to a patient who is named Henry Whitestone. The hospital decides to use the ABM and decides to allocate overheads on the basis of 3 activities. Well, these 3 activities are here it is. Let me change another color. Let's use blue. Okay. These these 3 activities are admission, procedures, and care. The hospital has computed the predetermined overhead allocation rates as printed on the slide. Well, let's see. For the first one, admission, the estimated overhead cost is 80,000. The second one, procedures, 200,000. The last one, care, 120,000. And in step 2, well, this is step 1. In step 2, the hospital estimated the quantity of allocation base. There are 800 hours, 2,500 tests, and 3,000 hours, respectively. So, in step 3, the hospital could determine the predetermined overhead allocation rates using the estimates in step 1 divided by the estimates in step 2. So it gets $100 for admission per each staff hour, $80 per test for procedures, and $40 per nurse hour for care. So let's assume the patient, Henry, had the following activities performed at the hospital. For admission, 1 staff hour is incurred. For procedures, 5 tests are incurred. And lastly, for care, let's assume 20 nurse hours are incurred to this patient. So we use the predetermined overhead allocation rate for each activity times the actual quantity of the allocation base used. We get 100 for automation, $400 for procedures, and $800 for care. So sum up them together, we can know the allocated overhead cost for this patient is $1,300. So at the end of the patient's stay, the hospital could have an accurate cost of provided health care to this patient. The hospital could then use the costing information to make decisions about prices to change the patient, to charge the patient, and also evaluate its activities and look for ways to cut the cost. Activity-based management is also useful in other types of service companies, such as an accounting firm, the law firms, etc., etc. So this is how activity-based management can be used in the service company. So next, let's see another type of management system, which is called just-in-time, JIT. Well, nowadays the competition is fierce. especially in technology-related manufacturing, where overseas companies are producing high-quality goods at very low cost. As we saw in the discussion of activity-based costing, there is a never-ending quest to cut cost. The cost of buying, storing, and moving inventory can be significant for companies. So, to reduce the inventory cost, many companies use JIT, just-in-time management system. Companies with JIT management system buy raw materials and complete finished goods just in time for deliveries to customers. In traditional manufacturing system, raw materials are ordered in large quantities to obtain volume discounts and to have surplus raw materials on hand in case some of the raw materials turn out to be defective. But under JIT management system, the manufacturer contracts with suppliers to deliver small quantities of raw materials as needed. Deliveries are small and frequent, and the suppliers must guarantee a close to zero defect rate. Because of the zero defect rate and quick delivery, the manufacturers can hold small amounts of raw materials in the warehouse and still be assured they won't run out of raw materials and have to shut down production process. For JIT management to work, relationships with suppliers of raw material must be very reliable to ensure that the company has raw materials just when they are needed to manufacture products. Because products are made as ordered, finished goods inventory are kept to a minimal amount. This reduces the company's cost to store and insure inventory. It also allows the company to minimize the resources it has invested in raw material and finished goods inventory. Lastly, because inventories are low, the risk of inventory becoming obsolete or unsaleable is very small. Production in JIT management system is completed in self-contained work cell. As you can see in the panel A of this slide. A work cell is an area where everything needed to complete a manufacturing process is readily available. Each work cell includes the machinery and labor resources to manufacture a product. Employees work in a team in the work cell and are empowered to complete the work without supervision. Workers complete a small batch of units and are responsible for inspecting for quality throughout the process. As the completed product moves out of the work cell, the suppliers deliver more raw materials to the work cell just in time. to keep the production moving along. By contrast, as is shown in panel B of this slide, the traditional production system separates manufacturing into various processing departments that focus on a single activity. Working process must be moved from one department to another. More movement with time. And as you know, the wasted time is actually a waste of money. So, under JIT management, customer demand in the forms of customers' order triggers manufacturing. The sales order pulls the materials, labor, and overheads into production. So this demand pull system extends back to the suppliers of raw materials. As noted previously, suppliers make frequent deliveries of defect-free materials just in time for production. Purchasing raw materials to meet customers' demands for final products reduces inventory. Less inventory frees floor space for more productive use. Thus, JIT management system help reduce waste. The traditional system requires more inventory and workers and the cost more to operate than in a JIT management system. Many companies credit JIT management for saving them millions of dollars, but JIT management systems are not without problems. With little or no inventory buffers, JIT system users lose sales when they cannot get materials on time or when poor quality materials arrive just in time. This is no way to make up for lost time. As a result, as noted earlier, strong relationship with quality raw materials vendors are very important to successfully implement a JIT management system. Additionally, many JIT management companies still maintain small inventories of critical materials. JIT costing leads many companies to simplify their accounting. JIT accounting, which is also called backflash costing, seems to work backwards. It starts with the output that has been completed and then assigns manufacturing costs to the units sold and to the inventories. There are three major differences between the JIT costing and traditional costing. First, as I said, it tracks the cost after the units are completed. Second, JIT costing combines raw material inventory and WIP inventory into one account, which is called raw and in-process inventory. Third, under the GIT philosophy, workers perform many tasks. Most companies use GIT, combine direct labor and manufacturing overhead costs into a single account called conversion cost. Well, as you can remember, the conversion cost account means direct labor plus manufacturing overheads. And in GIT costing, this account, conversion cost, is a temporary account that works just like the manufacturing overhead account. If you can remember, as I said, the balance of a temporary account must be 0. So it means at the end of the counting period, this account has to be adjusted to debit or to credit to a 0 balance. So this slide is a summary of the differences between traditional and GIT accounting. Well, basically, the major difference is that in traditional accounting, it records the cost of production as they move through the manufacturing process. While in GIT accounting, it records the cost of products backwards. It starts with the completed units. And in detail, in terms of inventory accounts, just-in-time GIT costing use one account to use one combined account to record raw materials and in-process inventory. And in terms of manufacturing cost, GIT costing uses one account, which is called conversion cost, to record direct labor plus manufacturing overhead. So this is the differences. To illustrate the GIT accounting, I will continue with our fictitious company example, Smart Touch Learning. Smart Touch Learning purchases raw materials to be used in the production of touchscreen tablets computers. These costs are recorded in the raw and in-process inventory accounts. All other manufacturing costs, including labor and various indirect materials and overheads, they are the indirect parts of the cost. All these indirect costs are accumulated in a conversion cost. So as previously noted, GIT costing doesn't have a separate WIP inventory count and raw material count. Instead, it uses only two inventory counts. They are raw and in-process inventory, as well as finished goods inventory. So now let's see the first transaction. Assume on January 1st, Smart Touch Learning has a beginning balance of 20,000 in $20,000 in raw and in-process inventory, and a beginning balance of $15,000 in finished goods inventory during the year. The company uses GIT costing to record the following summary transactions. First, the company purchased 305,000 of raw materials on account. So, since it is a on-account purchase of raw materials, the credit account should be accounts payable. Well, here we focus on the debit account. In traditional accounting, we should debit raw material accounts. However, as I said, in GIT accounting, there's only one combined account that records WIP and raw materials. So here we should debit this account, raw and in-process inventory account. Both accounts for same amounts of money. Next, Smart Touch Learning incurs $255,000 for labor and overhead. To record these accounts, as I said previously, that in GIT costing, there's only one account related to incurred labors, that is conversion cost. So here we need to debit conversion costs and credit wages payable, accumulated depreciation, etc., same amounts of money. Because in GIT, conversion cost means two parts of the cost. They are conversion cost includes labor costs plus manufacturing overhead. So that's why we should credit wages payable or accumulated depreciation, depending on the nature of this transaction. Well, let's go ahead and let's see the third transaction. Smart Touch Learning completed 2,000 standard model tablets. That's it moved to finished goods inventory. Recall that standard model cost of each standard model tablet is $276.75 as calculated using activity-based accounting. The debit to finished goods is at standard cost of $553,500. There is no separate WIP inventory account in GIT costing. So the Smart Touch Learning company should credit the following accounts. The first one is raw and in-process inventory account. This account is credited for the direct materials. And the second credited account is conversion cost. This account is credited for labor cost and indirect costs allocated to the finished goods inventory. So this is the key to JIT costing. The system doesn't track cost as the tablets move through manufacturing. Instead, completion of the tablets triggers the accounting system to go back and move costs from raw and in-process inventory, allocate conversion costs, and attach those costs to the finished products. So we can go ahead to the last transaction, the sales. Let's assume the company sold 1,900 tablets on account for $500 each. So for a total of $950,000. And the cost to these sales is $525,825. So for the sales transactions, it is basically the same as the traditional accounting. We make two entries. For the first one, we record the revenues based on the sales price. And for the second journal entry, we should record the cost. To debit COGS and to credit finished goods inventory. So this slide shows the company's relevant accounts in key account, combining the raw material inventory account with the WIP inventory account to form the single raw and in-process inventory account. Eliminates details and saves time. Not only time, but also cost. Saves both time and cost. So finally, let's see how adjustment is done in JIT costing. The conversion costs are underallocated by $1,500. The adjusting entry for underallocated cost is prepared to eliminate the ending balance of $1,500 in conversion cost. So this underallocation of $1,500 should be moved to COGS account. So that the balance of the ending balance of conversion costs at the end of the accounting period is 0. Because as I said, this account is a temporary account in JIT costing. Okay, lastly, let's take a look at the QMS. which stands for Quality Management System, and how it can be used to manage the qualities in a manufacturing company. So to be profitable, the companies must provide customers with quality products and services. Poor quality items cause sales to drop as customers become aware of quality issues. Additionally, defective items must be either repaired or replaced, which increases the cost. The combination of decreased revenues and increased costs can be devastating for a business, because just-in-time management systems have very little inventory on hand. Companies are far more vulnerable to production shutdowns if they receive poor quality or defective raw material. For this reason, it is critical that a company's raw materials be nearly defect-free. Well, to meet this challenge, each business function monitors its activities to improve quality and eliminate defects and waste. QMS, which stands for Quality Management System, are systems that help managers improve the business performance by providing quality products and services. There are several quality management systems currently in use, and the increased availability of software programs to assist in data collection and analysis has helped even small companies to adopt these systems. The common factor in all quality management systems is the desire to improve performance, which should result in increased customer satisfaction and increased profits. Continuous improvement is the primary goal of quality management system, and it is monitored in many ways. For example, the companies compare the cost of any changes they want to make against the benefits of the changes as one measure to aid decision making. Assume a company is considering reorganizing a work cell to improve efficiency. The reorganization costs $40,000, but the change is expected to result in a $100 reduction in production cost. So in this case, would the company want to implement the change considering its costs and benefits? Absolutely. Because this change is expected to net the company an additional $60,000 in profit. Well-designed products and production process reduce inspection, rework, and warranty claims. Investing in research and development can generate savings in customer service. World-class companies design and build quality into their products rather than having to inspect and repair them after the sales and deliveries to their customers. In QMS, there are 4 types of quality-related costs. First one, prevention costs are, well, it means the costs incurred to avoid poor quality goods or services. To avoid. The second cost, appraisal costs, are the costs incurred to detect poor quality materials, goods, or services. The third type is internal failure costs, which means the costs incurred to correct goods or services before delivery to customers. And the last type, which is external failure costs, which means the cost incurs after delivery to the customer has occurred. And of these four types of failure costs, the external failure costs are the most costly quality costs due to warranty cost and lost future sales. Well, this slide gives some examples of 4 types of quality costs. Most prevention, appraisal, and internal failure costs ultimately become part of the cost of finished products. External failure causes an increase in customer service costs, or it could cause lost sales due to an unhappy customer. External failure costs ultimately affect warranty expense claims, or sometimes even potential lawsuit liability exposed. Prevention of poor quality is much cheaper than external failure. Business should invest up fronting prevention and appraisal. The prevention and appraisal costs to reduce internal and external failure costs. Okay, let's reuse the example of smartest learning. Let's assume the CEO, Shana Bright, of this company is considering spending the following on a new quality improvement program. 4 activities. To inspect materials costs $100,000. To re-engineer to improve quality costs $750,000. To inspect finished goods would cost $150,000, and the preventive maintenance of equipment would cost $100,000. And also, the company expects this quality program to reduce the cost by the following amounts. $800,000 can be reduced due to avoid lost profits due to unhappy customers. $50,000 can be reduced due to fewer sales returns. $250,000 can be reduced due to decreases the cost of rework. And additionally, $100,000 can be reduced because of lower warranty costs. So, the CEO asks the controllers two questions. First, to classify each cost into one of the four categories and total the estimated cost for each category. And second, the CEO asks the controllers whether the company should undertake these quality improvement programs. After careful consideration, the controllers completes this report, which is shown on the slide. To compare the cost of undertaking the quality improvement program or continuing without this program. These estimates suggest that the company would save $100,000 by undertaking the quality improvement program, where $100,000 is the difference between the cost of implementing and the expected saves due to the implementation of this program. That is the difference between this amount and this amount. The difference, as you can see, is $100,000. But quality costs can be hard to measure. For example, it is very hard to measure external failure costs. Lost profits due to unhappy customers do not appear in the accounting records. Therefore, quality management systems use many non-financial measures, such as the number of customers compliance and the volume of incoming customer service phone calls, as the means to measure success or failure. Well, this is the end of this class, as well as the end of this chapter. The next week, there will be no class in the next week. The next week will be left for you to prepare the next assignment. So guys, I will see you on March 1st. All right, if you have any questions, please let me know. Bye-bye.